There is a ghost that haunts the financial world. It's a silent partner in every boardroom, an invisible passenger on every corporate jet. It whispers promises of growth, of expansion, of glory. It speaks of maximizing shareholder value, of efficiency, of moving faster than the competition. And for a time, it delivers. It makes heroes out of executives and geniuses out of analysts. But this ghost has a price. It demands payment not in dollars but in fragility. It devours resilience. It eats away at a company's soul, leaving behind a brittle shell that looks magnificent in the sunshine but shatters into 1,000 pieces at the first hint of a storm. This ghost is debt, and the ability to see it, to understand its true nature not as a tool but as a test of character, is one of the most powerful and protective skills an investor can ever possess. For decades, Warren Buffett has been trying to teach the world this one simple lesson, that when you look at a company's balance sheet, you are not just looking at numbers. You are looking at a transcript of its promises. You are reading a history of its choices. And in the column marked Total Liabilities, you are staring directly into the heart of its management, gauging their prudence, their patience, and their respect for the permanence of the capital you have entrusted to them. This isn't a lesson about accounting. This is a lesson about survival. It is the key to avoiding the single costliest mistake in the market: falling in love with a company's story during the good times, only to watch it evaporate in the bad. It is the financial transformation that allows you to stop being a speculator, guessing at the future, and start being a true business analyst, investing only in companies built with the fortitude to last for generations. This is the final promise that a balance sheet makes to you, if you only know how to read it. The very foundation of Warren Buffett's philosophy, the bedrock upon which the entire Berkshire Hathaway empire was built, was not forged in a moment of triumph, but in the slow, grinding agony of a mistake. It was a mistake he bought for $7.50 a share. The year was 1962, and a younger, more combative Warren Buffett was buying up stock in a struggling textile manufacturer from New Bedford, Massachusetts. The company was Berkshire Hathaway. At the time, it was just a name, a relic of the once mighty New England textile industry, now caught in a slow, irreversible decline. Buffett wasn't buying it for its long-term prospects. He was engaging in what he then called a cigar butt investment. The idea was that the company was so cheap, trading for far less than its working capital, that there was one last free puff of smoke left in it. The CEO at the time, Seabury Stanton, had been closing mills and selling off assets, and he'd made a verbal promise to Buffett to buy back his shares at a specific price, $11.50. It was a simple, profitable trade, but when the official tender offer came, Stanton offered only 11 3/8. It was a tiny difference, a matter of 12.5 cents per share. But to Buffett, it was an insult, a betrayal. Fueled by indignation, he didn't sell a single share. Instead, he started buying more. He bought with a vengeance, acquiring control of the company in 1965 with one single purpose: to fire Seabury Stanton. He succeeded, and in doing so, he found himself the proud new owner of a dying textile business. This single emotional decision would become, in his own words, a $200 billion mistake. For the next 20 years, he was locked in a brutal struggle against the terrible economics of the textile industry. The real problem, the one that burned the lesson of leverage into his soul, was the relentless need for capital. The textile machinery was in a constant state of decay. To stay even remotely competitive with firms that had newer, more efficient looms, he had to pour millions of dollars back into the business year after year. This was money that could have been invested in wonderful businesses, but instead it was being fed into the furnace of Berkshire's textile operations just to keep the fire from going out. And this is where the specter of debt made its presence known. The textile industry was notoriously capital-intensive and cyclical. To survive the downturns, companies often took on leverage, borrowing money to upgrade their equipment or simply to fund their operations when cash flow dried up. Buffett watched as his competitors did just that. He saw them go to the banks, sign loan agreements, and chain themselves to a fixed cost, the interest payment that had to be paid every single month, whether the mills were running at full capacity or sitting idle. He saw how that debt acted as an accelerant on their problems. A mild recession in the textile market would become a liquidity crisis for a leveraged company. A temporary drop in demand would become a desperate struggle to meet debt covenants. He realized that using debt in a business with already poor economics was like trying to swim across an ocean with an anchor tied to your feet. The slightest bit of fatigue, the smallest unexpected current, and you were dragged to the bottom. So he ran the textile business with an almost pathological aversion to borrowing. He starved it of capital when he could, and when he did have to reinvest, he used the company's own meager earnings. He refused to play the game of leverage. The experience was excruciating. It taught him that even the most brilliant management, even his own, could not turn a fundamentally bad business into a good one. But more importantly, it taught him that debt doesn't just add financial risk. It reveals a moral and intellectual failing on the part of management. It reveals a willingness to risk the entire enterprise for a shot at a slightly better return. It reveals an arrogance in the face of an unknowable future. It's a statement that says, I am so sure of the future that I am willing to bet the permanent capital of our owners on it. Standing in those deafeningly loud mills, watching the endless cycle of capital consumption, Buffett came to see debt not as a tool of corporate finance, but as a moral compass. A company's willingness to take on leverage was a direct signal of its culture, its priorities, and its character. A prudent, conservative management team, one that respected the capital of its shareholders as if it were their own grandmother's life savings, would shun debt. An aggressive, overconfident, or ego-driven management team would embrace it. This ordeal, this 20-year wrestling match with a terrible business, is what transformed him. He finally closed the last textile mill in 1985, but the lesson was permanent. Berkshire Hathaway, the holding company, would operate without significant debt at the parent level. Its balance sheet would be a fortress. The decision to take on debt, he concluded, is not a financial decision, it is a character decision. This deep-seated aversion to leverage isn't just a quirky preference, it's a profound understanding of human psychology, specifically the pervasive and dangerous cognitive trap known as the overconfidence bias. This bias is the tendency for people to have an excessive belief in their own abilities, their own knowledge, and their own predictions about the future. In the world of corporate executive decision-making, this bias runs rampant. A CEO who has overseen 5 consecutive years of record earnings doesn't just feel successful, they begin to feel infallible. They start to believe that their success is due entirely to their unique genius, rather than a combination of skill, luck, and a favorable economic environment. This is where debt enters the picture as a weapon of self-destruction. An overconfident executive looks at the future and sees only opportunity. They see a clear, linear path to higher profits. The possibility of a recession, a disruptive new technology, or a sudden shift in consumer taste feels remote, abstract, a problem for lesser managers. So when their investment bankers come to them with a proposal for a transformative acquisition or a massive share buyback program, all funded with cheap debt, it sounds like a brilliant idea. The math is seductive. Using leverage can amplify returns on equity, making their performance look even better. It can fuel the growth of their corporate empire, feeding their ego and justifying their ever-increasing compensation packages. They are, in their own minds, too smart to fail. They believe they can manage the risk. This is precisely where the agency problem collides with overconfidence. In corporate finance, the agency problem describes the inherent conflict of interest between a company's management and its stockholders. The CEO and the executive team are agents, hired to act in the best interests of the owners. However, their personal incentives are often misaligned. For a CEO, the upside of a huge, debt-fueled bet can be immense. A bigger company, a larger salary, fame, a legacy. The downside, however, is not fully borne by them. If the bet fails and the company is crippled by its debt load, the CEO might lose their job, perhaps walking away with a generous golden parachute. But the shareholders, the true owners, can lose everything. Their entire investment can be wiped out, a catastrophic risk they never consciously signed up for. Buffett's philosophy is a direct assault on this psychological flaw. By viewing a company's balance sheet as a window into management's character, he is looking for evidence that they have conquered the overconfidence bias. He is looking for humility. A management team that actively avoids debt is making a powerful statement. They are admitting that the future is uncertain and unpredictable. They are acknowledging that black swan events can and do happen. They are demonstrating that their primary duty is not to chase short-term glory, but to ensure the long-term survival and prosperity of the enterprise. They are, in essence, behaving like true owners, not like hired guns playing with house money. This approach treats capital not as an abstract tool for financial engineering, but as a sacred trust. It's a mindset that prioritizes resilience over returns, permanence over performance. In a world that celebrates bold, risk-taking leaders, Buffett champions the quiet, prudent steward. He understands that in the long run, the game of investing is won not by the brilliant, but by the disciplined. It's won by those who have the humility to respect risk and the wisdom to understand that the most dangerous risks are the ones you can't see coming. A clean balance sheet isn't just a sign of good financial health. It's a sign of good mental health in the executive suite. To translate this deep philosophical principle into a practical tool, you can use a mental model I call the owner's test. This isn't a complex spreadsheet or a fancy algorithm. It's a simple, powerful thought experiment that any retail investor can perform to cut through the noise of earnings reports and CEO interviews and get to the heart of a company's risk culture. It's a core component of any serious due diligence process. The goal is to shift your perspective from that of a fleeting stock trader who is merely renting a piece of paper for a few months to that of a permanent, sole owner who is responsible for the company's survival for the next 50 years. The first step is to locate the source material. Go to the company's investor relations website and download their latest annual report, the 10K. Ignore the glossy photos and the optimistic letter from the CEO for a moment. Scroll directly to the consolidated financial statements and find the balance sheet. Find the line item for total liabilities. This is the sum of everything the company owes to others. Write that number down. Next, find the line for shareholders' equity. This is the book value of what the owners, people like you, actually own. Now, step 2 is to provide context for that debt. A large number on its own is meaningless. You need to compare it to the company's earning power. Flip to the income statement and find the net income or net earnings for the past 5 years. Add them up. How does the total debt compare to the total amount of money the company has earned over the last half-decade? Is the debt less than, say, 3 times the average annual earnings? If a company has $10 billion in debt and has only earned a cumulative $1 billion over the past 5 years, you are looking at a flashing red light. This simple comparison gives you a rough idea of how many years of total profit it would take to pay back everything the company owes. The third and most crucial step is the simulation. This is where you truly adopt the owner's mindset. Imagine that you have just inherited this entire business. It is your family's only source of wealth, and your duty is to preserve it for your children and grandchildren. Now imagine a recession hits. It doesn't have to be a repeat of the 2008 financial crisis. A normal, garden-variety recession will do. Imagine the company's revenues suddenly drop by 30%. What happens to its profits? More importantly, what happens to its ability to make its interest payments? Look at the interest expense on the income statement. This is a fixed, non-negotiable cost. The company has to pay this to its lenders, or it will default and risk bankruptcy. In your simulated recession, with profits plummeting, does that interest payment suddenly look terrifyingly large? Is the margin for error razor thin? A prudent owner would never want to lie awake at night worrying if a modest downturn could bankrupt the family business. They would demand a huge cushion, a massive margin of safety. The final step of the owner's test is to render a verdict on management's character. Based on this analysis, are the people running this company behaving like careful stewards of your capital, or are they behaving like gamblers? Have they built a fortress designed to withstand any storm, or have they built a speedboat designed to go fast in calm waters, with no thought given to what happens when the waves get high? If you, as the hypothetical sole owner, would be uncomfortable with the level of debt on the books, then you should be uncomfortable as a minority shareholder. This mental model forces you to internalize the risk. It transforms abstract financial statement analysis into a visceral, emotional experience. It cuts through the jargon of corporate finance and asks a simple human question: does this feel safe? In a world of complex stock analysis, this simple test of prudence is often the only one you need to protect your portfolio from the greatest danger of all: the catastrophic, permanent loss of capital. To truly appreciate the wisdom of this conservative approach, we must spend time examining its antithesis, the path walked by the 99% of executives and investors who are seduced by the siren song of aggressive growth. This is the path of the empire builder CEO, a figure who has become a celebrated icon in modern business culture. This CEO is not driven by a desire for quiet, steady compounding, but by an insatiable hunger for scale, for headlines, for a legacy defined by size and scope. And the fuel for this ambition is almost always debt. The archetypal story of the empire builder is that of Valeant Pharmaceuticals in the early 2010s. Under its CEO, Michael Pearson, Valeant embarked on one of the most breathtakingly aggressive, debt-fueled acquisition sprees in corporate history. The model was simple and, for a time, intoxicatingly successful. Valeant would borrow billions of dollars to acquire other pharmaceutical companies, but it wasn't interested in their research and development pipelines. Instead, it would fire most of the scientists, slash the R&D budget to nearly zero, and then use its newfound market power to dramatically hike the prices of the acquired drugs. Wall Street fell in love. Analysts and hedge fund managers hailed Pearson as a visionary, a ruthless allocator of capital who was shattering the old, inefficient model of the pharmaceutical industry. The stock price soared, going from under $30 a share in 2010 to over $260 by mid-2015. Investors who followed this path felt like geniuses. They weren't just making money, they were part of a revolution. They ignored the balance sheet, which was bloating with an ever-increasing mountain of debt and an intangible asset called goodwill, the accounting plug figure representing the premium they paid for acquisitions. By 2015, the company had amassed over $30 billion in debt. The 99% saw this not as a risk, but as a sign of brilliant financial engineering. They were focused on the soaring revenue and the manipulated cash earnings figure the company promoted, not the rotting foundation underneath. The problem with an empire built on debt is that it requires constant forward momentum. The moment the acquisitions stop, the moment the growth falters, the entire edifice begins to shake. For Valeant, the reckoning came when its strategy of extreme price gouging drew political and public outrage. Scrutiny intensified, its accounting practices were questioned, and its ability to close the next big deal vanished. Suddenly, that $30 billion debt load was no longer a tool for growth. It was a millstone around the company's neck. The massive interest payments began to suffocate the business. The cash flow that was once used to hunt for new targets was now entirely consumed by servicing old loans. The stock price collapsed with a speed and brutality that was just as stunning as its ascent. In less than a year, it fell by over 90%, wiping out tens of billions of dollars in shareholder wealth. Investors who had felt like geniuses just months before were financially ruined. This is the path of the 99%. It is a path of impatience, of chasing exciting stories, of admiring aggressive CEOs, and of ignoring the boring, tedious work of balance sheet analysis. It is the belief that risk can be managed away, that growth at any cost is good, and the debt is just a sophisticated tool for smart people. The fall of Valiant is a testament to the fact that no amount of perceived genius can defy the laws of financial gravity. A business model that relies on constant leverage and acquisition is not a business model at all. It is a pyramid scheme waiting for a catalyst to collapse. Ignoring the character test of debt is to willingly walk into this trap, blinded by the allure of quick riches and the charisma of the empire builder. The character of a company's management, their prudence or their recklessness, is not an abstract concept. It manifests itself directly and quantifiably on the financial statements, most notably in the relationship between the income statement and the balance sheet. Understanding this direct financial connection is the key to seeing how a philosophical stance on debt translates into tangible financial advantage or disadvantage. Let's consider two hypothetical companies, Fortress Manufacturing and GrowthCo Industries. Both are in the same industry and both generate $100 million in operating income, or EBIT, earnings before interest and taxes. They are, from a purely operational standpoint, identical. The difference lies in their corporate finance philosophy. Fortress Manufacturing was built by a management team that despises debt. They have zero long-term debt on their balance sheet. GrowthCo Industries, on the other hand, is run by an empire builder CEO who has used leverage to fund acquisitions. They have $500 million in debt on their balance sheet, at an average interest rate of 6%. Now, let's trace the financial impact. For Fortress Manufacturing, the income statement is simple. They have $100 million in operating income. They pay their taxes, let's say $25 million. That leaves $75 million in net income. This entire amount is pure, unadulterated profit that belongs to the shareholders. It can be reinvested back into the business, used to pay a dividend, or used to buy back shares. It represents the full earning power of the company's assets. Now look at GrowthCo. They also start with $100 million in operating income. But before they can get to their profit, they have to pay the ghost. 6% interest on $500 million of debt is $30 million. This interest expense is a non-negotiable pre-tax charge. It is a direct transfer of wealth from the company's operations to its lenders. So GrowthCo's pre-tax income is not $100 million but $70 million. After they pay their taxes on that amount, roughly $17.5 million, their net income is only $52.5 million. Think about that. Two identical businesses with identical operations, but one delivers over 40% more in actual profit to its owners simply because of its capital structure. The debt acts as a massive tax, siphoning off a huge portion of the cash flow before it ever reaches the shareholders. This is the cost of debt in the good times. In the bad times, the connection becomes even more brutal. Let's imagine that recession we talked about earlier. Both companies see their operating income fall by 40%, from $100 million to $60 million. For Fortress Manufacturing, this is painful but manageable. Their new net income is $60 million minus taxes, resulting in $45 million of profit. They are still solidly profitable and in control of their own destiny. For GrowthCo, the situation is a catastrophe. Their operating income has fallen to $60 million, but their interest expense is still a fixed $30 million. It does not go down when times are tough. So their pre-tax income is now only $30 million. After taxes, their net income is just $22.5 million, a fraction of what Fortress is earning. But what if the recession is worse? What if operating income falls by 70% to $30 million? For Fortress, they are still profitable. But for GrowthCo, their operating income of $30 million is now entirely consumed by their $30 million interest payment. Their pre-tax income is zero. They are making no money for their owners. And if their operating income falls to $29 million, they now have an operating profit but a net loss after paying their lenders. This is the razor's edge of leverage. The balance sheet, through the mechanism of debt, imports a terrifying level of fragility directly onto the income statement. A company's debt load is a direct claim on its future earnings, a claim that stands in front of the owners, A prudent management team understands that their job is to maximize the cash that makes it all the way down the income statement to the net income line. And the surest way to do that over the long term is to minimize or eliminate the claims of lenders. The year 1998 was a period of blissful ignorance for most of the financial world. The dot-com bubble was inflating, markets were soaring, and a new era of permanent prosperity seemed to have dawned. But in a quiet, secretive office in Greenwich, Connecticut, a financial time bomb was ticking. This was the headquarters of Long-Term Capital Management, or LTCM, a hedge fund that was, by all accounts, run by the smartest people in the room. Its partners included John Meriwether, the legendary bond trader from Salomon Brothers, and two Nobel Prize-winning economists, Myron Scholes and Robert Merton. Their complex mathematical models were designed to exploit tiny, temporary pricing anomalies in global bond markets. And for a while, it worked with breathtaking success, generating annual returns of over 40%. The secret to their magic was not just their intelligence, but a staggering, almost unimaginable amount of leverage. For every $1 of their own capital, they had borrowed over $25, but even that number was misleading. Through the use of derivatives, their true exposure was well over 100 to 1. They had over $100 billion in assets, balanced on a tiny sliver of equity of less than $5 billion. And then, in August of 1998, Russia defaulted on its domestic debt. It was a shock, a Six Sigma event that their models had predicted would happen only once in the history of the universe. The carefully constructed correlations that underpinned their entire strategy suddenly broke down. Markets went haywire. What should have been small, manageable losses were amplified by their extreme leverage into a financial death spiral. In a matter of weeks, the fund lost over $4.5 billion, nearly all of its capital. The problem was no longer just theirs. Because they had borrowed from every major bank on Wall Street, their failure threatened to trigger a chain reaction that could bring down the entire global financial system. The Federal Reserve Bank of New York was forced to intervene, orchestrating a massive $3.5 billion bailout by a consortium of the very banks that had lent them the money. And who was one of the people they called in this moment of crisis to see if he would participate in the rescue? Warren Buffett. He and Charlie Munger put together a bid to buy out the entire portfolio, but the deal ultimately fell through. What was not lost, however, was the profound lesson of the entire affair. Here were literal Nobel laureates, men who had won awards for their understanding of risk, who had been brought to the brink of igniting a global financial meltdown. They had done so not because they were stupid, but because they had become slaves to leverage. Buffett's famous quote about the episode perfectly encapsulates his philosophy. To make money they didn't have and they didn't need, they risked what they did have and did need. That is foolish. It is just plain foolish. This story is the ultimate cautionary tale about financial fragility. It demonstrates that no amount of intelligence can protect you from the brutal mathematics of leverage. Debt doesn't care if you have a PhD or a Nobel Prize. It transforms small, unpredictable market events into existential threats. It removes any room for error, any cushion for bad luck. The downfall of LTCM was a real-world, high-stakes demonstration of what happens when you abandon the principle of a margin of safety. They believed their models were so perfect they didn't need one. Buffett, by contrast, structures his entire personal and corporate life around ensuring he has the largest margin of safety possible. His refusal to use leverage at the parent company level of Berkshire is a direct reflection of the lesson from LTCM. The smartest people can go broke, but the prudent man who avoids borrowing is simply far less likely to. He understood that the real goal isn't to maximize returns but to guarantee survival, because you cannot compound wealth from a starting point of zero. To fully grasp why debt is so dangerous, we need to look beyond the numbers and explore the deep-seated psychological principles at play. One of the most powerful forces in human decision-making is loss aversion. This concept, pioneered by psychologists Daniel Kahneman and Amos Tversky, describes our tendency to feel the pain of a loss about twice as intensely as we feel the pleasure of an equivalent gain. If you find a $100 bill on the street, you'll feel good. If you lose a $100 bill from your wallet, you'll feel absolutely terrible, and the negative emotion will be far stronger and more lasting than the positive one. Corporate debt is a mechanism that weaponizes loss aversion against the shareholder. When a company is debt-free, a bad year or a recession might lead to a drop in profits or a temporary decline in the stock price. This is a paper loss. It's unpleasant, but it's not permanent. As long as the company is fundamentally sound, it can recover. But when a company is heavily leveraged, a downturn can trigger a very different kind of loss, the risk of total and permanent wipeout. If the company's cash flow drops to a point where it can no longer service its debt, it can be forced into bankruptcy. In a bankruptcy proceeding, the lenders get paid first. The common stockholders are last in line, and they almost always receive nothing. Their investment is not just down, it's gone forever. Debt, therefore, transforms the risk from a manageable, recoverable loss into an unbearable, catastrophic one. This is directly related to what Buffett calls his paramount rule, the margin of safety. Popularized by his mentor, Benjamin Graham, the margin of safety is the principle of building a massive cushion between the intrinsic value of a business and the price you pay for it. But the principle extends far beyond just the purchase price. A true margin of safety must also be present in the company's operations and, most critically, on its balance sheet. Debt is the systematic destroyer of the balance sheet's margin of safety. A company with no debt has a huge margin for error. Its revenues can fall significantly, it can make strategic mistakes, it can endure a long recession, and it will still survive. It has staying power. A company with a high level of debt has no such cushion. A small miscalculation, a minor economic headwind, a bit of bad luck, any of these can be enough to push it over the edge. It is financially fragile. The writer and risk analyst Nassim Nicholas Taleb provides a brilliant framework for this, with his concepts of fragile, robust, and anti-fragile. A fragile system is one that breaks under stress, like a teacup. A robust system is one that resists stress, like a steel bar. An anti-fragile system is one that actually gets stronger from stress and volatility. A highly leveraged company is the definition of fragile. A debt-free company is, at a minimum, robust. And as we will see, a debt-free company with a war chest of cash can even be anti-fragile, using periods of market stress to its advantage. By avoiding debt, Buffett is not just following an old-fashioned rule. He is engineering a business and a portfolio that is psychologically sound. He is protecting his shareholders from the devastating pain of a total loss, the very event that our brains are wired to fear the most. He is ensuring that Berkshire Hathaway is not just robust but anti-fragile. This focus on survival and resilience over short-term optimization is a direct countermeasure to the cognitive bias of loss aversion. It recognizes that the key to long-term success is not hitting home runs, but religiously avoiding the strikeouts that take you out of the game permanently. To make this concept of financial fragility tangible, every investor should have a tool to stress test a company's balance sheet. You can call this mental model the recession simulator. It's a powerful, practical exercise that takes less than 15 minutes and can save you from years of financial pain. It allows you to peer into the future and see how a company might perform not in the best of times, but in the worst of times. This is the essence of defensive investing. Step 1 is to gather your raw materials. Once again, open the company's latest annual report, the 10K. You'll need 3 specific numbers. First, from the income statement, find the operating income, also known as EBIT, earnings before interest and taxes. This number represents the company's raw profitability from its core business operations, before any financing costs or taxes are taken into account. Second, also on the income statement, find the, interest expense. This is the fixed cost of the company's debt. Third, from the balance sheet, find total debt, which usually includes both short-term and long-term borrowings. Step 2 is to calculate the company's current margin of safety. The most common metric for this is the interest coverage ratio. The formula is simple: operating income divided by interest expense. For example, if a company has $1 billion in operating income and $100 million in interest expense, its interest coverage ratio is 10. This means its current profits are 10 times greater than what it needs to pay its lenders. On the surface, this looks safe. But this is just a snapshot in a healthy economy. Step 3 is the simulation. This is where you become the risk manager. You are going to simulate a recession by manually reducing the company's operating income. Ask yourself, what would happen if a recession caused the company's profits to fall by 30%? In our example, the operating income would drop from $1 billion to $700 million. The interest expense, remember, is fixed at $100 million. The new interest coverage ratio is now 7. Still safe, but less so. Now let's simulate a deeper recession. What if operating income falls by 50% to $500 million? The interest coverage ratio is now 5. Now simulate a severe recession, the kind that happens once every couple of decades. What if operating income plummets by 80% to $200 million? The interest coverage ratio is now just 2. The cushion is getting thin. The company is still profitable, but any further decline puts it dangerously close to the edge. And what if the unthinkable happens, and operating income drops by 95%? The operating income is now $50 million, but the interest expense is still $100 million. The company is now losing money and cannot cover its debt payments from its current earnings. It will have to dip into its cash reserves, sell assets, or try to borrow even more money just to survive. This is how a crisis begins. By running this simple simulation, you can see the breaking point. You can determine for yourself how much of a decline in business a company can withstand before it faces a genuine bankruptcy risk. A truly conservative, durable company, the kind Buffett loves, should be able to withstand a 50 or even 70% drop in operating income and still comfortably cover its interest payments. A company that enters the danger zone after only a 20 or 30% decline is a fragile investment, no matter how good its story sounds today. This recession simulator is a critical piece of due diligence for any retail investor. It forces you to think like a pessimist, to consider the worst-case scenario. It is a powerful antidote to the good times fallacy and a concrete way to measure a company's financial health and its true margin of safety. The greatest trap for the average investor is what can be called the good times fallacy. This is the tendency to look at a company's performance during a strong, stable economic period and extrapolate that success indefinitely into the future. It's a failure of imagination, an inability to envision a world different from the present moment. The 99% of market participants are deeply susceptible to this fallacy, and leverage is often the mechanism through which it leads to their ruin. Consider the airline industry in the years leading up to 2020. From a stock analysis perspective, many airlines looked fantastic. The economy was strong, travel demand was booming, and fuel prices were relatively stable. The companies were generating record profits. And what did they do with those profits? Guided by the principles of efficient corporate finance, many of them took on significant amounts of debt to fund massive stock buyback programs and to purchase new, more fuel-efficient aircraft. On the surface, this looked like smart executive decision-making. The buybacks reduced the number of shares outstanding, which artificially boosted earnings per share, EPS, a key metric that Wall Street loves. The new planes promised lower operating costs in the future. Investors who looked only at the income statement and the upward trajectory of the stock price saw a picture of health and prosperity. They saw brilliant management teams executing a winning strategy. They fell for the good times fallacy. They failed to perform the recession simulator. They ignored the balance sheets, which were becoming progressively weaker, laden with billions of dollars in new debt. They gave no thought to the inherent cyclicality and fragility of the airline business, which is exquisitely sensitive to economic shocks, geopolitical events, and, as it turned out, global pandemics. Then, in early 2020, the ultimate mild recession, in their industry's case, a complete and total shutdown, arrived. Air travel demand didn't just fall by 30%, it fell by 95% overnight. Suddenly, those record profits vanished and were replaced by staggering daily cash burns of tens of millions of dollars. And those debt payments, which seemed so manageable when the planes were full, became unbearable anchors. The interest expense didn't go away. The lease payments on the new planes didn't go away. These companies, which had looked so strong and successful just weeks before, were immediately facing acute bankruptcy risk. They were forced to go to the government, begging for bailouts, diluting their existing shareholders into near oblivion. Investors who had bought into the good times story were wiped out. This is the classic path of the 99%. They focus on the narrative, the growth, the earnings momentum. They mistake leverage-fueled growth in a bull market for managerial genius. They forget to ask the most important question: what happens when the party stops? The prudent investor, the one who applies Buffett's lens of debt as a character test, would have looked at the airline industry's balance sheets in 2018 or 2019 and felt a sense of unease. They would have seen the rising debt levels and recognized that management was making a massive, unhedged bet that the good times would last forever. They would have concluded that this was not a culture of prudence, but one of reckless optimism. And they would have stayed away, protecting their portfolio from the inevitable crash. Avoiding the good times fallacy by focusing on the balance sheet is not about being cynical. It's about being realistic. It's about acknowledging that the future is unknowable and that the only true defense is a financial structure built to withstand the worst of storms. The interplay between debt and equity is governed by the most fundamental equation in all of finance: assets equal liabilities plus equity. This simple identity is the blueprint of the balance sheet, and it provides a powerful, quantitative lens through which to see exactly how leverage creates financial fragility. Let's build a simple example to illustrate the mechanics. Imagine two companies, Safeco and LeverageCo, each wanting to buy a $10 million factory. Both companies have $1 million of their own cash to put into the project. Safeco, run by a conservative management team, decides to use its $1 million and simply build a smaller $1 million factory. Their balance sheet is simple: $1 million in assets, the factory, $0 in liabilities, and $1 million in equity, their own money. LeverageCo, run by an aggressive team focused on maximizing returns, uses its $1 million as a down payment and borrows $9 million from a bank to build the full $10 million factory. Their balance sheet is $10 million in assets, the factory, $9 million in liabilities, the bank loan, and $1 million in equity, their own money. Now, let's look at what happens in a good year. Both factories have a great year, and their market value increases by 20%. Safeco's $1 million factory is now worth $1.2 million. Their equity has grown from $1 million to $1.2 million, a respectable 20% return on equity. LeverageCo's $10 million factory is now worth $12 million. They still owe the bank $9 million, so their equity is now the difference. $12 million in assets minus $9 million in liabilities, which equals $3 million. Their initial $1 million equity stake has tripled. They have achieved a stunning 200% return on equity. This is the magic of leverage. This is why it is so seductive. By using other people's money, they were able to dramatically amplify their gains. The CEO of LeverageCo is hailed as a financial genius. But this amplification works in both directions. Now let's imagine a bad year. A recession hits, and the value of industrial factories drops by just 10%. For Safeco, this is a minor setback. Their $1 million factory is now worth $900,000. Their equity has dropped from $1 million to $900,000. They have a 10% loss on equity, but the company is perfectly fine. It has no lenders to answer to and can easily wait for the market to recover. Now look at LeverageCo. Their $10 million factory is also worth 10% less, so its value drops to $9 million, but they still owe the bank the full $9 million. Their assets are now $9 million, and their liabilities are $9 million. Their equity, the value belonging to the owners, has been completely and totally wiped out. A mere 10% decline in the value of their assets resulted in a 100% loss of shareholder equity. If the factory's value drops by another dollar, the company is insolvent. It owes more than it owns. This is bankruptcy. This simple example reveals the brutal truth of leverage. It is a double-edged sword that magnifies both gains and losses. The problem is that human psychology and business reality are not symmetrical. A 200% gain, while wonderful, does not change your life as much as a 100% loss, which takes you out of the game forever. By choosing to take on that $9 million in debt, the management of Leverage Co. made a conscious decision to expose their shareholders to the risk of total annihilation in exchange for the possibility of higher returns. The management of Safeco chose survival. This is the direct financial connection. Every dollar of debt on a balance sheet reduces the cushion that protects the shareholders' equity from the normal, unpredictable fluctuations in the value of the company's assets. It is a direct and measurable increase in the probability of permanent ruin. There is no greater story of the power of a fortress balance sheet than Berkshire Hathaway's own performance during the darkest days of the 2008 financial crisis. As the global financial system teetered on the brink of collapse, as venerable institutions like Lehman Brothers disappeared and giants like AIG were nationalized, most companies and investors were gripped by terror. They were playing defense, desperately trying to survive. Warren Buffett, however, went on offense. He was able to do this for one reason. For decades, he had cultivated a corporate culture that despised debt and worshipped liquidity. Berkshire Hathaway, the parent company, had a mountain of cash and virtually no debt of its own. Its balance sheet was not just strong, it was a strategic weapon. In late September 2008, just days after the Lehman Brothers bankruptcy had sent shockwaves through the world, Buffett received a call from the CEO of Goldman Sachs, one of the most prestigious investment banks on the planet. Goldman was sound, but in the panic of the moment, its funding was at risk. It needed not just capital, but a vote of confidence from the most trusted name in finance. Buffett provided both. He invested $5 billion in Goldman Sachs preferred stock that paid him a stunning 10% annual dividend. He also received warrants to buy another $5 billion of common stock at a fixed price. These were terms that no one else in the world could have commanded. It was, as one analyst called it, like taking candy from a baby. A few weeks later, another icon of American industry came calling: General Electric. GE's massive finance arm, GE Capital, was struggling to roll over its commercial paper, and the company's survival was in question. Once again, Buffett was the lender of last resort. He invested $3 billion in GE preferred stock, also with a 10% dividend and a kicker of warrants. Over the next few years, these deals would generate billions of dollars in profits for Berkshire's shareholders, but the profit itself is not the most important part of the story. The key is why he was able to make those deals. He could do it because he was not constrained by fear or financial necessity. He had no debt payments of his own to worry about. He had no nervous bankers calling him. He had no need to sell assets at fire sale prices. While the rest of the world was being forced to sell, he had the cash and the courage to buy. His fortress balance sheet gave him the financial firepower and, just as importantly, the psychological stability to be greedy when others were fearful. This is the ultimate payoff for decades of financial prudence. A conservative approach to debt is not just about portfolio protection in the defensive sense of avoiding losses. It is also about creating the capacity for explosive offensive action when opportunities arise. Crises and recessions are inevitable. When they occur, they transfer an enormous amount of wealth from the financially weak to the financially strong. Companies that are burdened with debt are forced to focus inward, to shore up their own survival. Companies that have pristine balance sheets are free to look outward, to acquire struggling competitors at bargain prices, to invest in new projects when costs are low, and to provide high-return financing to others, just as Buffett did. A fortress balance sheet provides options. And in the world of business and investing, options, especially options that are most valuable during times of maximum stress, are priceless. The strategic advantage of a debt-free company can be understood through the psychological lens of reactance theory. This theory posits that when individuals feel their freedom of choice is being threatened or eliminated, they experience a motivational drive to restore that freedom. This is the "you can't tell me what to do" instinct. Now, apply this concept to a corporation. A company's management team wants to have the maximum possible freedom to make decisions that they believe are in the best long-term interest of the business. Debt is the single greatest constraint on this freedom. When a company takes on a loan, it doesn't just receive cash, it receives a new set of masters. The lenders and their lawyers write up a contract, a set of debt covenants that dictate what the company can and cannot do. These covenants might restrict the company's ability to make further acquisitions, to pay dividends to its shareholders, or to invest in a new, unproven technology. The company must make its interest payments on time, every time, regardless of the state of the economy. The company must maintain certain financial ratios. Failure to comply with any of these rules can trigger a default, allowing the lenders to seize control of the company's assets. In this environment, management is no longer free. Their decision-making is distorted by the constant need to please the bankers. They are operating in a state of corporate reactance, constantly pushing against the constraints imposed by their debt. Contrast this with a company that has no debt. Its management team has almost complete freedom of action. They have maximum optionality. If a recession hits and their stock price is unfairly punished, they can choose to use their cash flow to buy back their own shares at a discount. A leveraged company, by contrast, might be contractually forbidden from doing so. If a promising new technology emerges, the debt-free company can choose to invest heavily in research and development, even if it means sacrificing short-term profits. A leveraged company worried about its next interest payment cannot afford such a long-term view. If a key competitor, who was foolishly leveraged, runs into financial trouble, the debt-free company can choose to acquire them for pennies on the dollar, permanently increasing its market share. This freedom, this optionality, is a staggering competitive advantage that doesn't show up in any standard financial model. A debt-free company's management team can focus 100% of their mental energy on running the business and creating long-term value. A leveraged company's management must dedicate a significant portion of their time and energy to managing their liabilities and keeping their lenders happy. Buffett's preference for unleveraged companies is a bet on the power of this unconstrained, focused management. He is investing in businesses that have the freedom to be patient, the freedom to be opportunistic, and the freedom to prioritize the long-term health of the enterprise over the short-term demands of creditors. He understands that in the complex, unpredictable game of business, the player with the most options, the most flexibility, is the one most likely to win over the long run. To identify these fortresses of financial freedom, you can use a mental model called the strategic cash hoard test. This goes beyond simply checking for the absence of debt and looks for positive evidence that a company views its balance sheet as a strategic weapon. It's a way to distinguish between a company that is merely debt-averse and one that is actively and intelligently building a war chest to exploit future opportunities. This is a critical piece of due diligence for entrepreneurs looking to model their own businesses, as well as for the retail investor. The first step is to conduct a quantitative analysis of the balance sheet. Look for two key items: cash and cash equivalents, and short-term investments or marketable securities. Add these together. This is the company's liquid firepower. How large is this number relative to the company's annual revenues or its total assets? A company that is consistently holding 5, 10, or even 20% of its assets in cash and safe liquid securities is making a very deliberate choice. It is paying a small price in lower short-term returns in exchange for massive long-term optionality. The second step is to analyze the company's cash-generating ability. A cash hoard is only truly strategic if it is constantly being replenished. Go to the cash flow statement and look at the cash flow from operations for the last 5 to 10 years. Is it consistently strong and positive? Now find the line for capital expenditures, which is the money spent on maintaining and growing the business. The difference between these two is the free cash flow. This is the surplus cash the company generates each year. A company with a large cash hoard and a powerful, consistent free cash flow is a financial fortress in its truest form. The third and most important step is qualitative. You need to get inside the mind of the management team. The best way to do this is to read their annual letters to shareholders. Go back and read the last 10 years of these letters. How do they talk about their balance sheet? Do they apologize for their large cash position? Or do they describe it with pride as a source of strength and opportunity? Do they have a clear track record of deploying this cash intelligently during periods of market turmoil? Did they buy back shares aggressively in 2009 or 2020 when prices were low? Did they make a savvy acquisition of a weakened competitor? Or do they just let the cash pile up indefinitely with no clear plan? You are looking for a management team that demonstrates patience, discipline, and a predator's instinct for opportunity. Charlie Munger has often said that the big money is not in the buying and selling, but in the waiting. The strategic cash hoard test helps you identify companies that are masters of waiting. They are building financial strength not for its own sake, but so they have the capacity to act decisively when the perfect pitch comes along. Investing in such a company is not just buying a collection of assets. It's forming a partnership with a management team that thinks about risk and opportunity in the same prudent, opportunistic way as the greatest long-term capital allocators. The path of the 99% is often paved with the very best of intentions, guided by the established dogma of modern financial theory. One of the most pervasive and dangerous of these ideas is the concept of the efficient balance sheet. For decades, business schools and Wall Street analysts have preached that a company holding a large amount of cash is inefficient and even lazy. Cash, the argument goes, generates a very low return. Therefore, a company's management has a duty to its shareholders to put that cash to work. This usually means one of two things: leveraging up the balance sheet to buy back the company's own stock, or using a combination of cash and debt to make a large acquisition. The pressure to conform to this dogma can be immense. Activist investors will target companies with pristine balance sheets, publicly shaming their management for being too conservative. They'll argue that by taking on debt and buying back stock, the company can instantly boost its return on equity and its earnings per share, causing the stock price to pop. For a CEO whose compensation is tied to these short-term metrics, the temptation is almost impossible to resist. The 99% of investors fall for this argument every time. They see an activist investor demanding a more efficient balance sheet and they cheer them on, hoping for a quick gain in their stock. They fail to see the insidious trade-off that is being made, the exchange of long-term resilience for short-term performance. Consider a hypothetical well-run company that has diligently built up a billion-dollar cash hoard and has no debt. An activist investor comes along and argues that the company should borrow another $2 billion and use the combined $3 billion to buy back its own shares. The plan is executed. The number of shares outstanding plummets and earnings per share magically jumps by 30%. The stock price soars, the activist and the other short-term investors sell their shares for a quick profit, and the CEO receives a massive bonus. Everyone seems to have won. But the company itself is now fundamentally weaker. It has gone from having a billion-dollar cash cushion to being burdened with $2 billion in debt. Its financial flexibility is gone. Its optionality has vanished. It is now fragile. When the next recession hits, the company that could have been a predator is now the prey. It is forced to cut its research budget, lay off valuable employees, and focus all its energy on simply servicing the debt that was so carelessly taken on in the pursuit of efficiency. The long-term patient shareholders are the ones left holding the bag. The dogma of the efficient balance sheet is a classic example of confusing sophistication with wisdom. It is a textbook theory that works perfectly in a world without recessions, without pandemics, and without unpredictable shocks. In the real world, it is a recipe for disaster. The prudent investor understands that a balance sheet's true purpose is not to be efficient in the short term, but to be resilient for the long term. A little bit of inefficiency in the form of a cash hoard is a small price to pay for the ultimate prize, survival. The true source of a company's strategic power flows directly from its cash flow statement. This financial document, often overlooked in favor of the income statement and balance sheet, is the bridge that connects them. It tells the story of how cash moves into and out of a business, and it is where the financial benefits of a fortress balance sheet become crystal clear. The cash flow statement is broken down into 3 sections: cash flow from operations, cash flow from investing, and cash flow from financing. A company with a conservative balance sheet has a massive, quantifiable advantage primarily in the financing section. Let's return to our example of Fortress Manufacturing, no debt, and Growth Co., $500 million in debt. Both generate, let's say, $150 million in cash from their core operations. For Fortress Manufacturing, the cash flow from financing section is simple and clean. They might have a small outflow for paying a dividend to shareholders, but there are no mandatory contractual outflows to lenders. For Growth Co., the story is very different. Their cash flow from financing section will show a large, recurring outflow for their $30 million interest payment. Furthermore, it will likely show another significant outflow for repayment of principal, as they are required to pay back a portion of their loan each year. Let's say this is another $50 million. So, of the $150 million in cash that Growth Co.'s business generated, a staggering $80 million, more than half, is immediately diverted to serve the company's liabilities. It is cash that can never be used to hire a new salesperson, build a new factory, or acquire a new technology. It belongs to the bankers. The ultimate measure of a company's financial power is its free cash flow. This is the cash left over after accounting for both operations and necessary capital investments. It is the discretionary cash that management can use to create value for shareholders. Because Fortress Manufacturing has no cash outflows for debt service, nearly all of its operating cash flow minus capital expenditures becomes free cash flow. Growth Co., on the other hand, sees its potential free cash flow decimated by its financing obligations. This has profound implications for long-term value creation. Over a decade, Fortress might generate, say, $1 billion in cumulative free cash flow. Growth Co., despite having identical operations, might only generate $300 million. That extra $700 million is the tangible financial payoff of a prudent balance sheet. Fortress can use that money to systematically buy back its own shares, increasing each shareholder's ownership stake in the business. It can pay a steadily increasing dividend. It can save it and build a massive strategic cash hoard. It can wait for the next market crash and then use its billion-dollar war chest to buy Growth Co., whose operations are just as good but whose balance sheet has rendered it vulnerable, for a fraction of its intrinsic value. This is how the game is won over decades. A strong balance sheet creates strong cash flow. Strong cash flow creates strategic options. And strategic options, when exercised with patience and discipline, are the engine of long-term compounding and the ultimate source of an enduring competitive advantage. For generations of investors, there was no safer, more reliable stock in America than General Electric. It was the quintessential blue chip, a cornerstone of retirement portfolios, a company whose business was so intertwined with the American economy that its success seemed as certain as the sunrise. Its CEOs, particularly the legendary Jack Welch, were celebrated as titans of industry, but beneath this veneer of stability and excellence, a cancer was growing. It was hidden not in its famed industrial divisions that made jet engines and power turbines, but in a sprawling, opaque entity known as GE Capital. GE Capital began as a simple financing arm, helping customers buy GE's own products. But over the years, it metastasized into a colossal, unregulated shadow bank. It borrowed massive amounts of money in the short-term commercial paper markets and used it to invest in everything from commercial real estate to private equity to subprime mortgages. By the early 2000s, this financial services arm was generating half of GE's total profits. This was a giant red flag that was hidden in plain sight. The 99% of investors, including most professional analysts, saw only the smooth, steadily rising earnings per share that GE reported year after year. They loved the story, they trusted the brand, they didn't bother to dig into the company's financial statements, which had become a labyrinth of complexity. If they had, they would have seen that GE's balance sheet was not that of a stable industrial company, but that of a highly leveraged, high-risk hedge fund. Warren Buffett himself famously said that he wouldn't invest in GE because he couldn't understand its financial statements, particularly the Byzantine structure of GE Capital. He knew that complexity is often a tool used to hide risk. The due diligence required to truly understand the company's liabilities was immense. And what you can't understand, you should not own. The house of cards came crashing down during the 2008 financial crisis. The short-term funding markets that GE Capital relied on to survive froze solid. Suddenly, this profit engine became a terrifying liability that threatened to bankrupt the entire company. GE's stock price, which had been a beacon of stability for a century, collapsed. It fell from over $60 a share in 2000 to under $7 a share in 2009. It was a wipeout that destroyed the retirement savings of millions of retail investors who had believed in the myth of GE's invincibility. In the years that followed, the full extent of the rot was revealed: massive hidden liabilities in its insurance divisions, a crippling pension deficit, and a culture that had prioritized financial engineering over industrial excellence. The fall of General Electric is perhaps the most important cautionary tale for any investor. It teaches us that reputation is not a substitute for rigorous financial statement analysis. It shows how leverage, especially when combined with complexity, can lead to a catastrophic and permanent loss of capital. And it proves that even the biggest and most respected companies can fail if their management loses respect for the fundamental principles of a conservative balance sheet. The warning signs were there, buried in the footnotes and the financial ratios, for anyone willing to do the work. The story of GE's collapse is a powerful illustration of two cognitive biases that often work in tandem to trap unwary investors: confirmation bias and information cascades. Confirmation bias is our natural tendency to search for, interpret, and favor information that confirms our pre-existing beliefs, while simultaneously ignoring or devaluing information that contradicts them. Once an investor decided that Churot, quote, is a safe blue-chip stock, their brain unconsciously went to work to defend that conclusion. They would focus on the company's long history, its iconic brand, and the positive reports from Wall Street analysts. When confronted with a red flag, like the increasing complexity of GE Capital or the rising debt levels, their brain would dismiss it as unimportant noise, or something, quote, too complicated for me to understand. They weren't engaged in a neutral search for truth, they were engaged in a biased search for validation. This is where the information cascade begins. An information cascade is a social phenomenon where a number of people make the same decision in a sequential fashion, often ignoring their own private information to follow the actions of others. The underlying assumption is that if so many other smart people are doing something, they must know something you don't. In the case of GE, an investor might have had a flicker of doubt about the company's debt. But then they would see that major pension funds, mutual funds, and their own neighbor were all heavily invested. They would think, all these professional managers and successful people have done their due diligence, they can't all be wrong. And so, they would suppress their own concerns and buy the stock, not based on their own analysis but based on the perceived wisdom of the crowd. Each person who buys the stock reinforces the cascade, making it even more powerful and convincing for the next person in line. This is how bubbles of false safety are formed around stocks that are, in reality, ticking time bombs. The only way to break free from these powerful psychological currents is to commit to doing your own independent work. Learning how to perform your own balance sheet analysis is the ultimate antidote to confirmation bias and information cascades. It forces you to confront the raw, objective facts, regardless of the prevailing narrative or the actions of the crowd. It is an act of intellectual sovereignty. When you read a balance sheet, you are not listening to the CEO's story or the analyst's opinion. You are listening to the numbers themselves, and the numbers do not lie. They do not have a marketing budget or a charismatic personality. They simply state the facts. Committing to this kind of rigorous due diligence is what separates the professional-minded investor from the amateur. It is the only reliable path to genuine portfolio protection. For the retail investor who doesn't have a team of accountants, performing a thorough due diligence on a company's balance sheet can feel intimidating. But you don't need to be a forensic accountant to spot the biggest red flags. You can use a simple, powerful checklist that I call the 5-minute balance sheet test. It won't tell you everything, but it will help you avoid the vast majority of financially fragile companies. First is the debt-to-equity ratio. This is the classic, quick and dirty measure of leverage. Go to the balance sheet and find total liabilities and total shareholders' equity. Divide the liabilities by the equity. This ratio tells you how much the company owes for every dollar of its owner's capital. A ratio of 1.0 means the company is financed 50-50 by debt and equity. As a conservative value investor, you want to see a ratio that is consistently below 0.5. This indicates that the company's assets are financed primarily by its owners, not its creditors. Second is the current ratio. This measures a company's ability to pay its short-term bills. On the balance sheet, find current assets, assets that can be converted to cash within a year, and current liabilities, bills that must be paid within a year. Divide the current assets by the current liabilities. A ratio below 1.0 is a major red flag, as it suggests the company might not have enough liquid assets to cover its immediate obligations. A healthy, conservative company will typically have a current ratio of 1.5, or ideally, above 2.0. Third is the debt trend. A single ratio is just a snapshot. You need to see the movie, not just the photograph. Look up the company's total debt figure for each of the last 5 to 10 years. Is that number stable, or, even better, shrinking as a percentage of assets? Or is it growing year after year, and perhaps growing faster than the company's earnings? A steadily increasing debt load is a clear sign of an aggressive or desperate management team. Fourth is the goodwill check. Goodwill is an intangible asset that gets created on the balance sheet when a company acquires another business for more than the fair market value of its assets. In essence, it's an accounting plug. A massive and growing goodwill account is a telltale sign of an empire builder CEO who is on a debt-fueled acquisition binge. If goodwill makes up a huge percentage of the company's total assets, you should be very skeptical. It often represents a history of overpaying for acquisitions, an act of hubris that will eventually come back to haunt shareholders. Finally, and most importantly, is to read the footnotes. The numbers on the balance sheet only tell part of the story. The real secrets are often buried in the footnotes to the financial statements. You don't need to read every word. Use the find function on your computer to search for key phrases like debt covenants, which will tell you the specific rules the company must follow to avoid defaulting on its loans. Search for off-balance sheet financing or special purpose entities, which are common ways companies try to hide their debt. And search for, quote, contingent liabilities, which are potential future obligations like lawsuits that haven't hit the main balance sheet yet. A quick scan of the footnotes can often reveal risks that the summary numbers conceal. This 5-minute test is a powerful filter. It will help you quickly discard the vast majority of companies that do not meet a conservative standard of financial health, allowing you to focus your deeper research on only the most prudent and resilient businesses. The most common and destructive mistake made by the 99% of investors is what I call income statement myopia. It is the obsessive focus on a company's income statement, its revenues and its earnings per share, while almost completely ignoring the health of its balance sheet. This is a dangerous and misguided approach because the income statement is the easiest financial statement for a company to manipulate in the short term, and debt is the most common tool used for this manipulation. Imagine a company with a mediocre but stable business. Its revenues are flat, and its stock price has gone nowhere for years. The CEO is under pressure from the board to create shareholder value, so he decides to embark on a massive, debt-fueled share buyback. The company borrows $1 billion and uses it to purchase its own shares on the open market. Let's see what happens. The company's balance sheet is now significantly weaker. It has a new billion-dollar liability, and its cash has been depleted. Its bankruptcy risk has increased dramatically. But the average investor doesn't look at the balance sheet. They look at the income statement. Because there are now fewer shares outstanding, the company's total earnings are divided by a smaller number. This magically causes the earnings per share (EPS) to jump. Wall Street analysts, who are often just as myopic, see the rising EPS and upgrade their ratings on the stock. Automated trading algorithms, programmed to buy stocks with positive earnings momentum, kick in. The stock price starts to rise. The investor with income statement myopia sees the rising EPS and the rising stock price and concludes that the business is fundamentally improving. They see the CEO as a genius. They buy more shares. They are completely blind to the fact that the company's foundation is rotting from the inside out. They are celebrating a short-term accounting trick that has been purchased at the price of long-term fragility. This is not a hypothetical scenario. It has been the dominant story of the last decade of corporate finance. Countless companies have sacrificed balance sheet strength for the sake of goosing their EPS figures through buybacks. This creates an illusion of progress. It makes the income statement look fantastic, while the balance sheet becomes a ticking time bomb. The prudent investor understands that the income statement is subservient to the balance sheet. A company's earnings are only valuable if they are durable and sustainable. And durability comes from a foundation of financial strength. The investor who trains themselves to always read the balance sheet first is arming themselves against the most deceptive practices in corporate finance. They can distinguish between real operational improvement and fake, financially engineered improvement. This skill alone is enough to avoid the catastrophic losses that inevitably occur when the debt-fueled illusions finally meet a harsh economic reality. To achieve true financial mastery, you must learn to see the three core financial statements, the income statement, the balance sheet, and the cash flow statement, not as separate documents, but as an interconnected, dynamic system. Every decision a company makes reverberates through all three. Understanding these linkages is the essence of financial statement analysis. Let's trace the full life cycle of a single fateful decision, a company's choice to take on debt to acquire a competitor. It begins on the balance sheet. The company borrows $1 billion. The cash on the asset side of the balance sheet goes up by $1 billion, and the long-term debt on the liability side goes up by $1 billion. The balance sheet remains in balance. Now, the company uses that cash plus some of its own to buy the competitor for $1.5 billion. This is an investing activity, so it shows up on the cash flow statement as a $1.5 billion outflow in cash flow from investing. On the balance sheet, the cash account goes down, and a new asset, likely a combination of tangible assets and goodwill, appears. The balance sheet is now fundamentally changed. It is larger, but it is also leveraged and carries the dead weight of goodwill. Now the consequences of this decision begin to bleed into the income statement. The new $1 billion debt comes with an interest rate, let's say 5%. This creates a new $50 million interest expense on the income statement every single year. This expense reduces the company's pre-tax income and its final net income. Furthermore, the goodwill from the acquisition may need to be amortized or tested for impairment, which can create another non-cash expense on the income statement, further depressing reported earnings. Finally, the cycle comes full circle back to the cash flow statement. The lower net income means there is less starting cash for cash flow from operations. And the new debt requires not just interest payments but also principal repayments. These repayments are a direct outflow in the cash flow from financing section. This entire cascade of events was set in motion by that one initial decision to take on debt. The balance sheet, the foundation, was weakened first. This weakness then created new, permanent expenses on the income statement. And those expenses, combined with principal repayments, now drain cash flow year after year, reducing the company's financial flexibility and its ability to respond to future challenges. This is how corporate finance works. The balance sheet is the source code. It dictates the strength and stability of the entire system. A decision to weaken the balance sheet with debt will inevitably, mathematically, lead to a weaker income statement and a weaker cash flow statement in the future. The retail investor who understands these connections can think like a CFO. They can see the second and third order consequences of a company's actions. They can look at a decision made today and understand its likely impact 5 years from now. This holistic view is the key to moving beyond simple stock analysis and into the realm of true, long-term business analysis. The ultimate goal of value investing, the end game for which all these principles of prudence and risk management are designed, is to harness the phenomenal power of long-term compounding. But the true magic of compounding is not just about high returns, it's about uninterrupted time. And the most beautiful illustration of how a debt-free foundation can fuel this compounding machine is the story of See's Candies. In 1972, Warren Buffett and Charlie Munger, through their company Blue Chip Stamps, acquired See's Candies for $25 million. See's was a wonderful business. It had a beloved brand, a loyal customer base, and a simple product that people loved to buy year after year. Most importantly, it was a financial marvel. It required very little capital to operate. It had no debt. And it produced a prodigious amount of free cash flow. A normal manager, an empire builder CEO, would have looked at See's and thought about how to leverage it. They would have borrowed against its steady earnings to open hundreds of new stores across the country, or to acquire other candy companies. They would have tried to squeeze every last drop of growth out of it. Buffett and Munger did the exact opposite. They recognized that the genius of See's was not its potential for growth, but its ability to produce cash without needing to consume it. They kept the business's footprint largely the same, focusing on maintaining its quality and brand. And they took the cash that See's generated every year, the free cash flow, and they redeployed it elsewhere. The $2 million in pre-tax earnings that See's was producing at the time of purchase became a fire hose of capital. Over the years, that number grew and grew, eventually gushing out over $2 billion in cumulative free cash flow to Berkshire Hathaway. This was cash that required almost no new capital investment to generate. It was the perfect raw material for compounding. Buffett used the cash from See's Candies to buy other wonderful, unleveraged businesses, like the Buffalo News and the Washington Post. He used it to build Berkshire's massive insurance operations. See's Candies became the engine. It was the original, pristine source of permanent capital that funded the early growth of the entire Berkshire empire. This story reveals the highest purpose of a fortress balance sheet. It's not just about playing defense and surviving recessions. It's about creating a stable, reliable source of capital that can be used to play offense, to acquire more and more cash-generating assets over time. A leveraged company is a cash consumer. It must constantly feed its lenders. A debt-free, high-quality business like See's is a cash producer. By assembling a collection of these cash producers, Buffett created a self-reinforcing system, a compounding machine where the profits from one set of businesses provided the fuel to buy the next set. This is the long-term power of prudence. It is a patient, deliberate strategy that may seem slow and boring in the short term, but over decades, it builds an unstoppable force of wealth creation. The reason so few people are able to follow this patient, prudent path lies in another deep-seated cognitive flaw known as hyperbolic discounting, or more simply, present bias. This is our powerful, innate tendency to prefer smaller, immediate rewards over larger rewards that are further in the future. We would rather have one cookie right now than be promised two cookies tomorrow. This bias governs countless human behaviors, from procrastination to poor saving habits. And in the world of corporate finance, taking on debt is the ultimate act of succumbing to present bias. When a company borrows money, it gets the reward immediately. The cash appears in its bank account today. It can use that cash to build a new factory, launch a new product, or acquire a competitor right now. The positive effects are immediate and tangible. The cost and the risk of that debt, however, are pushed into the future. The interest payments, the restrictive covenants, the increased bankruptcy risk, these are all problems for tomorrow's management team, for the future shareholders. The current CEO gets to enjoy the ribbon-cutting ceremony for the new factory. The consequences of the loan that paid for it may not be felt for years. Warren Buffett's entire philosophy is a rebellion against this cognitive trap. He has structured his mind and his company to prioritize the future over the present. He is willing to accept slightly slower, more deliberate growth today, in exchange for the near certainty of survival and immense rewards in the distant future. When he passed on countless exciting deals during the dot-com bubble, he was sacrificing the immediate gratification of being part of the party for the long-term reward of preserving his capital. When he holds tens of billions of dollars in cash earning a paltry return, he is enduring the small present-day pain of inefficiency in order to have the massive future option to deploy that capital when a crisis occurs. This is an incredibly difficult cognitive feat. The entire world, from Wall Street analysts to the financial media, is geared towards celebrating short-term performance. CEOs are rewarded for this quarter's earnings, not for the company's resilience a decade from now. Overcoming this pressure requires a rare combination of intellectual independence, emotional discipline, and an exceptionally long time horizon. It's about consciously choosing the two cookies tomorrow over the one cookie today, and doing it over and over again for 50 years. The investor who can align themselves with this way of thinking, who can learn to love the delayed gratification of a prudent balance sheet, is adopting the mindset of the world's greatest compounder. They are choosing to optimize not for the present moment, but for the entire journey. To operationalize this long-term mindset, you can use a final mental model, the permanent capital test. This elevates your analysis from a simple financial check to a profound judgment on stewardship and long-term partnership. When you buy a stock using this model, you are not just purchasing a piece of paper that you hope to sell to someone else at a higher price. You are making a conscious decision to allocate a piece of your family's capital to a specific management team, and you are doing so with the intention of leaving it there permanently for decades. Before you make such a commitment, you must ask yourself, does this management team think about debt, risk, and capital in a way that I am comfortable with for the next 20, 30, or 50 years? This is no longer just about ratios. It's about philosophy. It's a marriage of your personal financial values with the corporate finance values of the company you are about to own. To answer this question, you must go beyond the numbers and study the language and actions of the leadership. Read every shareholder letter they have written. Do they speak with the swagger of an empire builder, celebrating their latest transformative debt-fueled acquisition? Or do they speak with the humility of a steward, discussing the importance of their fortress balance sheet and their duty to preserve shareholder capital? When a recession hits, what do? Do they panic and dilute shareholders to raise emergency capital? Or do they calmly deploy their cash reserves to buy back shares at depressed prices, as a true owner would? Do they have a long, consistent history of avoiding leverage, even when it was fashionable? Or do they seem to follow the latest fads from Wall Street? This test forces you to think of an investment as a relationship. You would not go into business with a partner who you knew was a reckless gambler, no matter how charming or intelligent they seemed. In the same way, you should not allocate your permanent capital to a management team that has a demonstrated history of gambling with the balance sheet. This mindset is the ultimate form of defensive investing. It ensures that you are only partnering with people who share your fundamental respect for capital. It aligns your financial future with companies that are managed not for the next quarter, but for the next generation. It is the final and most important filter in the quest to build a portfolio of truly durable, conservative businesses that are built to last. The final and most powerful temptation that the prudent investor must resist is the, quote, siren song of leverage. The 99% of investors are constantly bombarded with stories of incredible wealth created through the aggressive use of debt. They read about private equity firms that buy companies with 90% borrowed money, make a few operational changes, and then sell them a few years later for a massive profit. They hear about hedge fund managers who use leverage to make spectacular returns in the currency or bond markets. And they start to believe that leverage is a magic wand, a tool for getting rich quick that they should be using too. This is a fatal misconception. For the average retail investor, trying to replicate these strategies by buying heavily leveraged public companies is the financial equivalent of trying to perform brain surgery on yourself after watching a TV show. The private equity firms and sophisticated hedge funds that use leverage successfully operate with a completely different set of tools and advantages. They have direct control over the companies they buy. They can replace management, sell off divisions, and directly implement their strategies. They have teams of lawyers and workout specialists who can renegotiate debt terms if things go wrong. They have access to capital markets and financing terms that are unavailable to the public. They are playing a different game with different rules. When a retail investor buys stock in a highly leveraged public company, they have none of these advantages. They have no control. They are a passive minority owner, completely at the mercy of the existing management team and the unforgiving terms of the company's lenders. They are taking on all the downside risk of leverage, the magnified losses, the bankruptcy risk, without any of the control or sophisticated tools that the professionals use to manage that risk. The siren song of leverage is a dangerous illusion. It promises a shortcut to wealth, but for the 99%, it is a well-marked path to financial ruin. It confuses a specialized, professional tool with a universally applicable strategy. The prudent investor must learn to plug their ears to this song. They must accept that the path to sustainable wealth is not through financial engineering and daring feats of leverage, but through the patient, disciplined ownership of simple, understandable, and conservatively financed businesses. The goal is not to get rich quick. It is to get rich for sure. We have now arrived at the grand conclusion, the final and most profound financial connection that ties all of these principles together. The ultimate purpose of avoiding debt, of demanding a fortress balance sheet, of partnering only with prudent management, is to protect and unleash the single most powerful force in the universe of finance, the uninterrupted compounding of capital over time. The formula for compound interest is simple, but its implications are staggering. The most important variable in that formula, the one with the most explosive potential, is T for time. Your job as a long-term investor is not to find the company that will grow the fastest next year, but to find the companies that can survive and grow for the next 50 years, allowing the variable of time to do its magical work. Debt is the single greatest enemy of time. It is the enemy because it introduces into the equation the small but ever-present possibility of a permanent, catastrophic loss. A bankruptcy event is not a temporary setback, it is a reset button. It stops the compounding clock and brings your capital for that investment down to zero. From zero, you can no longer compound. Let's imagine two investors. Investor A is aggressive. He invests in exciting, leveraged companies that promise high growth. For 9 years, he does brilliantly, earning an average of 20% per year. But in the 10th year, a sharp recession hits, and one of his key holdings, burdened by its debt, goes bankrupt. He suffers a 50% portfolio loss. Investor B is prudent. She invests only in debt-free, durable companies. Her portfolio grows at a much more boring 10% per year, every single year, because her companies are resilient enough to weather any storm without facing an existential crisis. After 10 years, who has more money? Investor A, despite his years of brilliant returns, has seen his initial capital grow by only about 60%. Investor B, with her slow and steady approach, has seen her capital grow by over 150%. She has won, and she has won by a massive margin, not because she earned higher returns, but because she completely avoided the big loss. She stayed in the game. She allowed the compounding machine to run, uninterrupted. This is the ultimate financial payoff for a lifetime of prudence. By making a conservative balance sheet your absolute non-negotiable requirement for any investment, you are systematically eliminating the single greatest threat to your long-term wealth. You are ensuring that time is on your side. You are trading the intoxicating possibility of short-term brilliance for the comforting certainty of long-term success. It is the final promise of the balance sheet, the one that guarantees that if you are patient enough, the power of compounding will work its inexorable, life-changing magic for you. You have just spent this time acquiring a powerful mental tool. You have learned to see past the noise of the market, past the seductive stories of growth, and to look directly at the financial bedrock of a company. You now understand that a balance sheet is not just a spreadsheet. It is a testament to a company's character, a predictor of its resilience, and the ultimate guarantor of its long-term survival. This ability to distinguish between genuine strength and fragile illusion is a permanent upgrade to your investing skill set. It is a shield that will protect your capital for the rest of your life. But what you have mastered today is a single crucial piece of a much larger intellectual machine. Warren Buffett's success is not built on one pillar, but on a network of interconnected mental models that support and reinforce one another. Understanding a company's debt is like having a high-resolution map of its defenses. But to truly understand its value, you also need the map of its competitive advantages, the map of its management's capital allocation skill, and the map that tells you if the price is right. Each model is a piece of the puzzle, and their true power is only unleashed when they are combined. The video that is now on your screen is not an accident. The algorithm has identified it as the next logical step in your journey, the next piece of the map. It holds the link that connects the principle of financial strength you've just learned to the next critical component of the system. Clicking to watch it is not about passing the time. It is a conscious decision to continue your ascent, to add another weapon to your mental arsenal. The average person stops here, content with one piece of knowledge, but you have demonstrated the patience and focus to go deeper. The question is, will you continue? Will you complete the arsenal? The next link in the chain is right there, waiting for you.